Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hello and welcome to the India Market Outlook podcast mini-series, which outlines our key investment views and how investors should be positioned in the current market scenario. My name is Ravi Singh. I'm the Chief Investment Strategist at Standard Chartered Bank India, and I'll be your host for this podcast. We started 2024 with a lot of optimism. Our strategy of sailing with the wind has performed well in 2024 on the back of strong pre-election market rally and decline in domestic bond yields. During this period, economic growth and corporate earnings performance exceeded consensus expectations. Further, the incumbent government voted back for the third consecutive term, albeit with a reduced majority, did boost risk sentiments. As we get into the second half of this year, we expect shifts in domestic fiscal and monetary policies to influence Indian asset performance. Economic growth and corporate earnings momentum is likely to normalize from the strong pace of fiscal 2024 but stay above trend. Government continuity offers policy stability, but a reduced majority could see a broadening of policy focus. We see this potential inflection point as a good time for investors to adapt to shifting winds, which is the theme for our H2 Outlook 2024. For investors, this can be implemented through the three-pronged strategy. First, in our foundation allocations, we stay neutral on equities. Now, Indian equities have delivered strong returns in the first half of this year. Nifty index rising 11%, driven by several positive structural and cyclical drivers. Domestic growth and corporate earnings momentum has exceeded expectations amid declining bond yields and robust domestic investor inflows. Government continuity was an additional tailwind for risk assets, assuaging investor concerns on policy focus. We expect the current strong macro and earnings cycle to sustain over the medium term. However, in our foundation allocations, we are tactically neutral on equities given the following factors. First, normalization of the pace of domestic growth and corporate earnings in fiscal 2025. Second, expensive valuations of domestic equities, both absolute and relative to peers. And third, a view of modest policy easing by the RBI given still elevated inflationary pressures. Within equities, we stay overweight large cap equities given better margin of safety in terms of both earnings and valuations compared to mid cap and small cap equities. In addition, large cap equities with relatively better balance sheet strength could help it to withstand shifts in the macro environment. The second strategy is to capitalize on the carry and price gains that is possible on Indian bonds. We expect Indian bond yields to see a sustained decline given a confluence of positive structural drivers. Firstly, since the adoption of inflation targeting framework in 2016, inflation, bond yields and policy rates have seen a secular decline with relatively minor overshoots. Further, RBI's policy actions have been supported by supply-side interventions by the government to manage energy and food article prices, increasing the effectiveness in managing price stability. Secondly, the government has stuck to the path of fiscal consolidation and is on course to reach the fiscal deficit target of 4.5% by fiscal 2026, as committed to the Parliament during the pandemic. Third, and most importantly, Indian onshore bonds inclusion in emerging market sovereign bond indices of JP Morgan and Bloomberg, followed by India's sovereign rating outlook upgrade by S&P Global. This is an outcome of a series of past policy measures aimed at improving macro stability and domestic bond market access for overseas investors. Further, this is likely to improve the demand and liquidity in the Indian bond market, supporting better price discovery, lower yields and borrowing costs of the government and domestic corporates. While all of these are positive factors for bond yields declining lower, one factor which could keep the bond yields a little volatile is the outlook on inflation. We expect RBI to stay on hold till inflation declines closer to its medium-term target of 4% on a durable basis, or if growth impulses start to fade. Our view of lower bond yields over the next 12 months is driven by improved demand and supply dynamics for onshore bonds given lower borrowing requirements and steady inflows from mutual funds, insurers and index tracking foreign funds. This view supports our preference for medium and long maturity bonds given the still attractive carry or yields and the potential for higher price gains as yields decline. The third and most important strategy is to navigate market volatility with a balanced portfolio. The second half of 2024 could continue to witness intermittent surge in market volatility given a busy election calendar which includes key state elections in India and the US presidential elections. the ongoing geopolitical tensions in the Middle East, and potential divergence in central bank policy easing cycle are additional risks. We believe a diversified asset allocation, which comprises of a neutral allocation to bonds, equities, golds, and cash, remains a prudent strategy for the coming months. Now, gold has been the top performing asset in first half of 2024. What we find most interesting is how the gold rally continues to be driven by a tight demand-supply balance rather than falling bond yields. We see room for this to continue given central bank demand remains strong, while the direction of yield turns more supportive as the rate cuts gather pace. While we retain a neutral view on gold's experience of the first half of this year has been a lesson on why it is important to build an allocation to gold within foundation portfolios. Cash finally serves as a dry powder for any future opportunities. Liquid alternatives, market neutral, and other strategies that have a low correlation to traditional assets are potential routes to achieve portfolio diversification. Well, that's all the time we have for today. Do reach out to your relationship manager for a copy of our latest market outlook, or log into online banking at www.sc.com/in and find it in the SC Invest section. If you enjoyed this podcast, please like and subscribe. Thanks very much.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered relationship manager or visit www.sc.com/in.